You know, a few weeks ago, I did a video about the S&P 500 and how it's a little bit of a lie because it makes it look like the stock market's doing really well because stocks like the one you see on screen here, Microsoft, have really outperformed. And because the S&P 500 is a market-weighted index, it pulls the index, the S&P 500, higher, even though most of those 500 stocks aren't doing all that great. Well, this week I thought I would show you how to know when to buy these large cap tech stocks, these ultra liquid stocks that are heavily weighted in the S&P 500. There's some very simple rules for when to buy, when to sell, and this week I'll show you that. Plus, I'm going to take a look at the overall market. We'll figure out where stocks in general are likely to go in the near term, and we'll look at interest rates. Are they likely to finally start to fall, or what is the bond market saying about the future direction of rates? And then finally, we'll look at the trade of the week. That's all coming up in this week's Stockscores Market Minutes. All right, so let's talk about the Super 7. It's Amazon, it's Apple, it's Google, Meta, Microsoft, NVDA, and Tesla. These stocks have a heavy weighting in the makeup of the S&P 500 because that index is a market-weighted index. So when you look at an exchange-traded fund like the SPY, which is probably the most liquid and actively traded ETF, what you're looking at is an index that is made up of 500 companies, but it's heavily weighted by the largest in those companies because it's a market-weighted index. So Microsoft is now the largest company in the world, and so it has the heaviest, strongest weighting in the S&P 500. All right, so what that means is that most stocks in the market could be doing really poorly, but the index still looks quite good. And that's what we talked about a couple weeks ago. What I want to look at this week is how can you know when to buy and when to sell some of these really large cap, ultra liquid stocks. I have a very simple method that will take you 5 minutes a week. And if you apply it, you can latch on to these big large cap companies when they're starting to turn. And one of these stocks in the Super 7 is probably going to give us one of these signals soon. The other 6, maybe it's too late, but I'll show you when to sell those ones. All right, so long-term traders, they can apply just a very simple strategy looking for stocks that are breaking their weekly downward trend line after the formation of a rising bottom. And you can sell when the upward trend is broken from a falling top. Now, that's a lot of gobbledygook. Let's show it visually. So let's start with a chart here of Amazon. And you can see the downward trend in Amazon going back to 2022 across these peaks was broken in May of 2023. Now that's the easy part. That's the break of the trend line. All you have to do is draw a line across the tops, all right? Now the next thing you need to do is decide whether there was a rising bottom before the break of the downward trend line. And you can see that there was. This low here is higher than the previous low. So that would have been the week to buy Amazon. Now you might say, oh, it was much better to buy it here when it first started to go up, or even here. But I'm telling you that the probability of buying here is not that great. It would be similar to buying here or buying here, and ultimately the stock still went lower. It is best to wait for the build of a rising bottom and a break of the downward trend line. And there you see a stock going from 110 to now a little over $170 a share. Well, let's walk through a few more. Here's Apple. Its downward trend line there, breaking it in January of 2023, but no rising bottom. So you need to wait for the build of the rising bottom in order to get the probability at its maximum, and then the break right there. So in this case, it was March of 2023 before it was time to buy. Now notice that the upward trend line on Apple was broken here. However, also notice that there was no falling top yet. It's only here that you broke down from a falling top, and really Apple has been an underperformer since then. It's gone more or less sideways. It had a little rally for November, December, as most of the market did, but it's been kind of stagnant since then. Next one is Google. There was its downward trend line, rising bottom, break from a rising bottom, and still in an upward trend. We have not seen a breakdown from a falling top. Now, this astute among you will say, well, there was a breakdown here, you're right, but not from a falling top, from a new high. And so we continue to be in that upward trend. Even though Google had a bit of a rough week this week, it hasn't actually broken that long-term downward trend line, so it remains a hold. All right, let's take a look at Meta. This one presents another important lesson, which I'll explain in a moment. Downward trend line, rising bottom, break from a rising bottom in January, and look at the performance. 140, 150 to where it is now 480. This is now a danger stock. And the reason is that it has run away from its trend line. See how far the current price is from the trend line? There's no sign of weakness in this stock. I don't want anyone to think I'm saying sell Meta. However, it's dangerous because when stocks run away from their trend line, they usually pull back to it. And so I think chasing this stock now is very risky. I would not be a buyer here, but still hold, and you might see a sell signal soon. Next one, same principles. And of course, a lot of these charts are going to look the same because they're all in the same industry, but there's rising bottom, break of the downward trend line. Here it breaks this upward trend line, but from a new high, so no sell signal. And then here, breaks the pullback, resumes the upward trend line, and it still remains a hold. Now it too, like Meta, is getting a little bit above its long-term upward trend line. If I draw that line there, see how far price is above the trend line? So Microsoft is getting a little bit overbought and is likely to make a pullback in the next little while. No sign of one yet, but something to watch for. NVDA, same thing. Rising bottom, downward trend line broken, still in the upward trend, overbought because it's far above the trend line, likely to pull back soon. Now here's the stock that has really not kept up and is probably the one that's going to give the next buy signal. Because the stocks that give the buy signals are the ones that have been doing poorly. They need to break their downward trend line from a rising bottom. And the only one of the Super 7 that's in a downward trend is Tesla. Now here you can see I can draw a line across these tops, and really that line can go all the way back to 2021. And so if we break this line after the build of a rising bottom, then we would have a buy signal. Now, keeping this trend line in mind, notice that when price rallied, and it had a nice little rally which a position trader could have taken advantage of, but notice when it hit the downward trend line that had been established by these price peaks much longer ago, that's where it got stuck. And so you can see that just drawing lines with a ruler on a chart is very insightful about where stocks will go. Now, the lesson here also is we have this little bottom of this channel. This is called a channel. And we've hit that channel 2 times, and we're now at it for the 3rd time. So Tesla doesn't look good in the longer term, but in the short term, I think there's a good chance that we will see Tesla make a little bounce in the near term. A bounce that is appropriate for maybe a swing trader, someone trading off of the 15-minute or the hourly chart. Not appropriate for the longer term trader who looks at these weekly charts, because the upside in the weekly terms is relatively low. But if you are a day trade, not a day trader, a swing trader, you could take advantage of it. And you apply the same principles. Let's go into Stockscores and pull up Tesla. And instead of looking at a long-term chart, what if I looked at a 1-month chart? Now you can see that there is a downward trend line on this chart, which each bar is 2 hours. And it potentially is building a rising bottom. And it could break that downward trend line from a rising bottom, which would be a signal to buy for a swing trader. A swing trader is someone who can watch the market a little bit during the day. If you're a longer term trader, you can only look at the markets on the weekends, or that's all you desire to do, then stick with looking at the weekly charts. But if you're a shorter term trader, then you can apply these same principles to a much shorter time frame. All right, let's get into the normal market analysis that I do each week. We're going to start with the S&P 500, SPY, and again, recognizing that this index is heavily weighted by those big 7 stocks, of which 6 of the 7 are doing very well. Nice bullish market here. You can see the trend is up. Show you a little something. If I change this to RSP symbol, RSP is an equal weighted version of the S&P 500. Same 500 stocks, but it is equal weighted, which means each stock has the same weighting. And notice that while the SPY is reaching to new highs, we're in a sideways range in the SPY going back the last 6 or 7 weeks. So that's the difference there. And that's really because those Super 7 stocks are doing well. But even on the equal weighted chart, applying those principles, you had, and this is on the daily time frame, build of a rising bottom and a break of the downward trend line from a rising bottom. It's just such a simple method that can get you into markets and stocks early in the upward trend. The key though is to apply this to fairly actively traded large cap stocks like real companies. More speculative things, I think you have to take a shorter term view. But if you are looking at well-known companies, this is a great little method, a great strategy, very simple, doesn't take a lot of wizardry to apply. All right, well, let's take a look at QQQ. And this is, of course, the NASDAQ 100, which is also a market-weighted index, heavily influenced by the large cap tech stocks that make it up. Good bullish market there. Looking at the 3-year chart, you can see bullish market there. It remains a hold, but getting a little overextended, probably due for a pullback. How about the IWM? Well, now we're into the Russell 2000 index, and you can see the difference. It is not keeping up with those large cap indexes. And the reason is interest rates have a much greater effect on small cap stocks than on the large cap stocks. And so the reason this market is underperforming is because interest rates have been high, and that has a heavy negative influence on them. I think this market still looks okay. If we look at the 1-month chart, we're going to see pretty much sideways, so neutral there. Looking at the 3-year, it's getting close to the point where it could break out. We've got a rising bottom. We just need the breakthrough resistance from the rising bottom. So let's see if that materializes. We're going to talk a minute in this video about interest rates and where they're likely to go, and that will have a big influence on this, and I'll give you my thoughts on that in just a moment. But first, let's take a look at the Canadian market, T.XIU. 3-year chart is got a bit of an upward trend starting. Upside a little bit limited by this resistance over here, but still has some upside. In the short term, for those who are more trader oriented, it's made a move up. It's now in a pullback, and the next leg should be up. Heavily influenced by commodities, so gold, 3-year chart, is got an upward bias, but not a real strong trend. It's a little bit choppy. And the short-term chart is more or less neutral. All right, now what about oil? Last week I said oil was looking pretty good, and it went and made a sharp pullback Thursday and Friday. Doesn't mean it's bad yet, because it still has an upward or a downward trend line that was broken from a rising bottom. And as long as that rising bottom low, this support zone here, as long as it holds, we should see this market bounce and continue up. But I'm a little disappointed with the way the oil market moved on Thursday, quite a sharp move down. Obviously, oil is heavily driven by politics, by what's going on in the Middle East, and that's a very unpredictable thing going on over there. So we'll see how this pans out. I think you still have to be a little bit cautious with oil, but it does show signs that it's trying to turn. All right, let's take a look at currencies now. The US dollar, short term, bullish. See, the trend is up, bottoms are rising. Long term, it's kind of neutral, stuck in this sideways range. Bitcoin, here you have the upward trend that was broken from a new high, but that's not a reason to sell, it's a reason to be cautious. Now it potentially is building a falling top, and so if it breaks down through this upward trend line from a falling top, then that is a big negative and you'd want to stay clear of it. Until that happens, it remains a hold, with a little cautionary note. All right, I said we're going to look at the bond market and the future direction of interest rates. Here it is. You can see we had a little rally in the market this week. That means bond prices were going up, interest rates were going down. Okay, again, the reason the market rallied November and December, bond market was going up, interest rates were going down. That was supportive for stocks. If we look at the long-term picture, we are still in a downward trend. But we are right at the downward trend line, and we may have formed a rising bottom. Looks like we have. So the next step is we just need to break this downward trend line. If that happens, then I think you want to start to look at buying the broader market, not just the big seven, but the broader market, specifically some of those small cap markets, because they will tend to do better when the market is better. All right, so my ratings on these different markets. US large cap stocks, NASDAQ, still bullish, but getting a little extended, so risky. Small cap stocks neutral. I think that'll be the next place to look for opportunity if we get a break in the bond market. Canadian stocks bullish on both time frames, but really underperforming the US markets. Gold and oil neutral on both time frames. US dollar bullish in the short term, neutral in the long term. Bitcoin still long-term bullish, but a little shaky in the short term, so I've got it at neutral. And then bonds neutral on both time frames, but at the point where it could break very soon. All right, now let's take a look at the trade of the week. This is a stock that we picked up in the Stockscores active live daily webinar, which I do every day, live trading and algorithmic calls from my computers. And this is one that we picked up on with that algorithm, which looks for abnormal trading activity. It happened, well, it started to trade abnormally through the day, even the day before. But here is the action candle breaking through resistance from rising bottoms. That's an ascending triangle pattern, breakout with decent volume building, and it went sharply higher, parabolic. Remember I talked earlier about when trends go parabolic, the bubble's about to burst. So the bubble burst right there, pulls back to the trend line, couldn't hold it, but by that time on the day trade you're in, you're out somewhere in there for about 4 or 5 times risk, which means for every $1,000 risk, $4,000 or $5,000 of profit. Great trade in a relatively slow Friday. Well, I hope you've enjoyed this week's video. Hopefully learned something about some basic strategy for trading large cap liquid stocks in the longer term time frame. If so, click on the like button, subscribe to the channel, and most importantly, trade well.